Hi, this is Mike Maloney with Jeff Clark once again. Jeff, how are you doing?
I'm doing great, Mike. Good to see you today. We have an interesting theme with our video today. It's a purchasing power theme or lack thereof. So we've got all our usual things, including our meme of the day, which will stick in with our theme. So here we go. So our first thing today, Mike, is our article of the day. And Dan, our producer, liked the article I wrote yesterday for our website called the Fiat-Free-For-All. It's the currency creation versus gold and silver production. And the reason I wrote this, Mike, is because a lot of investors, analysts focused on the Fed's announcement of interest rates, the potential change in interest rates. But there wasn't really much about the fact that they're going to continue their QE program, which is $120 billion per month in currency creation they're going to continue. So I wanted to compare that to gold and silver production. And that's what this chart shows. There is $120 billion of currency creation per month. And then you see the gold production. That is the value of monthly global gold production, which is, and then there's silver there. And gold production, the currency creation, I'm sorry, is about 8.5 times greater than gold production. And currency creation is about 75 times higher than silver production. So it's quite insane when you think about how much currency they continue to create every month. So there's a lot in this article. It's worth reading. But Mike, what's your reaction to all this information about the contrast here?
Well, I think it's a great article, and the information in it. I mean, if you go further down, you're talking about the loss in purchasing power of the. One of the most amazing things is, you've got currency creation 10 seconds, gold and silver production 10 years.
Yeah.
Now, so that's much greater than the factor of 75 times. That's huge.
Yeah.
I don't know what the difference is between 10 seconds and 10 years, but that is enormous. And it shows you how, using precious metals, they can't inflate the currency supply. But the loss of purchasing power, $1 in the year 2000, so just since the beginning of this century, now only buys you 63 cents worth of stuff. That is tragic. And then, you've got the
And that's based on
gains.
the CPI, Mike, not
Yeah,
which
which
is
I
not.
call the CP line because it's even, it's even worse than that. So it's probably around, the dollar has probably lost 50% of its purchasing power in the real world. A little bit over the CP line. Um, uh, and when you get down to the purchasing power adjusted for inflation of gold and silver from the beginning of the century, what you've got here is the first trading day. Obviously, Friday was the first, but the first is New Year's, and so the markets are closed. So this is January 4th of 2000, very first trading day of this century. And you've got the price of gold at 281.50, and adjusted for inflation, it's up hugely. And then you look at silver, and silver's purchasing power, it's gone from $5.30 to 16.38. So it's up. The purchasing power has grown 209% over the original value. However, silver fell until November of 2001 was the low. And if you take that low, it's about a 350% gain in absolute purchasing power. So we've gone from $4.03, I believe, was the low, all the way up to where we are today. And that's some huge gains. In fact, when you look at the nominal gains, you're talking about 550, gold and silver both being up about 550% from their lows to today, and the stock market being up about 275% from its 2000, in 2001. So it just shows you that gold and silver, when they're in their bull markets, not only protect your purchasing power, but you can make these enormous gains in purchasing power during that bull market period. It's not just a safe haven asset, but it's also the asset with the greatest potential gains in purchasing power when they're in their bull markets. And that's where we are today. The other thing that I have to say about this article, you talked about the creation of currency every single month, the $120 billion in bonds every single month. Well, they're counterfeiting currency into existence. I like where you said that they just, how did you say it? Most currency today is basically imagined by a central bank. That's awesome. Great writing. And they do imagine this stuff into existence, but to get it into circulation, they buy something real with it. This is the immoral thing. And I just made a chart. I'll include this for the video. But while you were introducing this, I created this chart on the Federal Reserve, and we've gone from about the Fed assets, the Fed's balance sheet, being about 6% of GDP before the year before the crisis of 2008. So the Fed owned by creating currency from nothing, counterfeiting, and buying stuff with that counterfeit currency. They bought about 6% of all of the goods and services created in a year in the United States, that equivalent value. Today, that is up at 34%, more than a third of GDP, all the goods and services bought and sold in an entire year, an entity where we've legalized theft. I mean, we should, people don't have pitchforks anymore, and we don't know how to make torches, but we should be storming the castle with our pitchforks and torches at this point. More than a third of the annual economy, that value, which is incomprehensible to the average person. I mean, these are numbers that are just completely incomprehensible. And they have actually stolen that through the counterfeiting of currency. They've stolen a third of GDP. That's on an annual basis. The actual value of the United States is equivalent to a whole lot more than 1 year's worth of transactions. But still, these are immense numbers. And the morality of this is so immoral, creepy. I mean, this should be against the law. And it is for any private person. You would go to jail if you did it. I would go to jail if I did it. But the Federal Reserve, it's okay. We made it legal for them. So,
and Mike, consider that this doesn't even include, as a good friend of mine in Canada pointed out, this doesn't even include fractional reserve lending. This isn't the entire money supply. Oh man, I had such a good record of saying currency. This isn't currency. Darn, I've gone a half a year without getting gonged. So anyway, this isn't even the entire currency supply. So it's even worse than portrayed. And like I say in the article, it's not even an apples to apples comparison, because it's Fed printing versus.
Well, another thing is that these are emergency maneuvers. This is what you do during a crisis: is you create $120 billion in bonds a month and get the American citizens 120 billion. Did I say million? I'm not sure. But you get the American public another $20 billion deeper in debt every single month. We're getting that much deeper in debt. 120 billion.
And Mike, when I was writing this article, I got paid from Gold Silver while I was writing this article, and I realized that paycheck is never going to buy me anything more than it will right now.
Right.
Those dollars that I got paid are only going to lose purchasing power. It's a slow leak in the boat. Yeah. And yet gold and silver, as history shows, not only maintain, but can increase your purchasing power. So I bought more gold myself. So
yeah. Okay. So what's next?
On to our tweet of the day. And this is from Willie Woo. And he says, congrats to the Fed, new high score. And he says, basically, if you're not getting 22% return on your investments in 2021, you're actually going backwards. The black line in his chart is the M2 monetary inflation. The red is CPI inflation. So you're not even keeping up with monetary dilution if you don't earn at least 22% on your investments this year. So pretty good point.
Yeah.
What do you think, Mike?
Well, there's two things I want to point out in this chart is the amazing correlation in the past. And so if that holds true, we're in for some huge inflation in the future. And then the other thing to point out to everybody is if you look at the red line before we had before we had the Federal Reserve, there would be inflation and deflation, inflation and deflation. There's a zero line there. And the red line would go above it and then below it and above it and below it. So basically the price of things remained stable throughout that century before the Fed. And this chart goes all the way back to the end of the Civil War. This is amazing. And then after the Fed, it always stays on the side of positive inflation, stealing purchasing power. The natural state of things is slow, mild deflation. We always get more efficient at what we do. So the number of human hours invested in building a house, in making a car, it doesn't matter what it is, keeps on going down and down and down and down, as well as getting the materials. You know, two guys used to take axes and one of those saws that they each get on the end of and chop down a tree. And it would take so many human hours to take a tree, get it onto a truck, get it to a sawmill, turn it into lumber, and then all those guys hammering together a house and working with hand saws and everything. And the amount of time was probably much greater than a factor of 10 to build a house. It's probably come down by more than 90% as far as labor and effort involved. Today, a big machine grabs a tree, snips it off, strips off all of the branches and puts it on a truck in seconds. And the same thing at the sawmill. And then you go to a big, huge housing complex that's being built, and they're all using nail guns. And instead of one home going up in six months, it's 120 homes that go up in 6 months. And so the efficiencies, slow, mild deflation is the natural order of things. Our currency should always buy us more tomorrow than it does today. And this chart shows that ever since the Fed was created, that the difference between whatever the natural inflation is and the natural deflation should be, and what the actual inflation is the amount of theft. That's the amount of purchasing power stolen from us.
Yes, good point. Well, if you're liking this video, please hit the like button down there below for us and subscribe to the channel so you always get our videos. So on to our chart of the day, Mike, and this is from Max Fisher. The RSI, and these are technical indicators of the gold price he's talking about, the relative strength index and the Bollinger Band combo has marked short-term lows in the gold market. And you can see that he's circled there in green down below the RSI and the Bollinger Bands, and they tend to correspond with lows in the gold price. And you can see this chart just from the other day is marking a potential low in gold now. So
yeah, the
Mike,
Bollinger Band one is even, that's like a record low in this chart. So yes, I was looking at the gold price yesterday and I was going to make an insider's video saying this recovery from the, because I made a significant purchase Friday before last. And but it looked yesterday like it was going to roll over. And today we did roll over and take out the bottom. So there might be a little bit of downside left here, but not much. And the Bollinger Bands and RSI are sort of showing that. And so the opportunity to buy down at these prices, there may be a little bit more opportunity within the next week. We may even break 1,700 in the next few weeks. I don't know, but we may not. It might just go up from here because it's in such oversold conditions. But yeah, this is these are the time. Buying the dips is important. That's what I did Friday before last. I caught the low of the day, and that turned out to be the low in the past week and a half. So, but now we're we just plumbed some new lows today. So we'll see where this goes. But to me, this is the time to accumulate. We were up over 1900. So, now we're able to save $150 an ounce. If it could go down even further, we might be able to save $200 an ounce over what it was just a couple of, a month ago or so.
Yes, very good.
Yeah.
Well, on to some viewer feedback. And Mike, this is in reaction to our video from last week when we talked about the IMF creating SDRs, special drawing rights, and potentially replacing the US dollar as the reserve currency of the world. So Too Much Debt here says, the IMF is a reboot of Animal Farm. Quote, all rights are special, but some have special drawing rights.
Yeah, in Animal Farm, it's all animals are equal, but some are more equal than others.
Right.
And so, yeah, this is and that's right. And I urge people to try and find out what an SDR is, special drawing rights, what that is. And you'll find it's just another pyramid scheme that's stacked on top of the fiat currency, the national fiat currency pyramid schemes, which are stacked on top of national debts. So it's a derivative of a derivative of debt. It's crazy, just totally insane.
Yes,
Okay.
It is. Well, on to our meme of the day, and this keeps with our theme of purchasing power today. So, Mike, tell us about this meme. This is a good one.
This is that kind of makes you think, doesn't it? It says the same 15 cents in the 1950s can buy you the same burger today. And I remember being able to buy a McDonald's hamburger for 15 cents and French fries for a nickel. And so this is a silver dime and a nickel. That silver dime today is, as of today, is worth $1.86, so almost $2. And that nickel is worth 6 cents worth of nickel. So look for the nickel to be replaced with zinc or something like that sometime soon, because it's exceeded its face value. And if it exceeds it significantly, they will, debauch it by using some sort of base metal. But what's interesting is we just took a look at the prices of McDonald's hamburgers, and it's actually 99 cents. So with that dime, you basically get two. This dime and nickel now add up to about $2. So, so now you get two burgers if you're using that money that we used to use, the real money. Now, a couple of other interesting facts here is that the new dime, which is basically it's like a bologna sandwich, except it's a copper sandwich, and there is no silver in it whatsoever. That dime is worth less than a penny. A penny is worth like 2.6 cents today. A zinc penny is worth 2.6 cents, and a dime is worth 2.2 cents. So,
and yet in silver, they're worth more.
Yogi Berra used to say, a nickel just ain't worth a dime anymore.
Right.
Here, a dime ain't worth a penny. And that's true.
Very good.
I want to thank everybody for watching. We'll see you next time. Thanks, Jeff.
Thanks, Mike. See you next time.